Hello, everybody, and welcome. Today, my guest is Winnie Chwang. Winnie is a portfolio manager at Matthews Asia, and she manages the firm's China Small Companies Fund, as well as the China Fund. Welcome, Winnie.
Hi, Tom. It's nice to be here today.
Winnie, today we want to talk about the Chinese capital markets and recent developments. So the world looks to China, especially as COVID-19 seems to come to an end. How has the Chinese market developed since the apparent end of the pandemic?
Well, Thomas, thanks for that question. Actually, the trend has been ongoing for quite some time, not just during the pandemic. What we, always share with our clients is that the evolution of the Chinese economy has been happening. So as we know right now, around 60% of China's GDP composition is really made up of more knowledge-based type sectors in that of services and consumption. So that has actually been a trend that has been ongoing for a while now. These new economy sectors are rising in terms of influence. And this is a good thing for us as investors because from an earnings per share standpoint, the cyclicality and it will be a lot less going forward in terms of the good consistency of earnings, as well as the quality of earnings in China is also improving. Now, for me, what's happened during the pandemic has perhaps helped China to be a little bit more elevated on the global stage. It has demonstrated that it has been able to contain the virus well, and also to recover much quicker than many other countries. So for 2020, it was actually the only major economy in the world to have posted positive GDP growth. Looking into 2021, we continue to feel that just given the strength of the containment and the success in the containment of this pandemic, we expect that China will continue to grow resiliently this year at a growth pace between anywhere between mid-teens to high teens. So it's certainly an ongoing journey for China in terms of the development and the evolution of its economy and the equity markets there.
So there are some China equity strategies available, and most of them invest into the larger companies. You have a different approach. You're managing a small cap mutual fund. So what makes the small cap segment interesting for investors at the moment?
Yes, investing in China's small caps is interesting because it's quite a unique exposure that you get. It tends to be a very, very differentiated approach in investing in this part of the market. And small caps are interesting, firstly, because they do play a very important role in China's growth. So you can see that, in terms of GDP contribution, in terms of new patents, in terms of things like employment, they play a very critical and crucial role. And are important and front and center of China's growth. They're also a lot more insulated from geopolitical matters. Much of China's small companies derive the major source of their revenues from the domestic market itself, which makes them less prone to the fluctuations and the volatility of macroeconomic matters. The profile of the company that you invest in the China small companies context is also likely to be more entrepreneurial and also more privately oriented. And this is a big universe. It's one of the largest small cap universes in the world, and it presents an opportunity for a lot of discovery. 80% of our universe is actually in the A-shares, where information is still relatively limited at the moment. So we do believe that through an active approach, we are able to identify a lot of good opportunities and fast-growing companies at a very early stage of their development.
So from a portfolio manager perspective, how is it different investing in small caps in comparison to large caps, especially when I think about the research process, gathering information about companies?
Sure. Yeah. Firstly, just to touch on how it's different from investing in more often all cap or a blue chip oriented index. We often get this question. And I think one of the areas in which investing in Chinese small caps is different is the universe's exposure to some of these knowledge-based sectors that we just discussed. So in areas such as IT and healthcare, you'd find that they comprise about a third of the small companies universe. Now, this is 3 times larger than that of the exposure that you will get in all cap index. I think on the other hand, though, I think in the all cap space, you do certainly get access to internet giants. They're listed in the blue chip index. You also get access to a lot more financials. They tend to be large cap and not represented in the small cap universe. So it's a very differentiated type of approach, and different types of, you get different types of opportunities across these two different ways to invest in China. Now, what we have actually been sharing with our clients is that just given the prominence of China in its role as a part of overall GDP composition and how much it accounts for overall GDP growth, and also the fact that the many, for instance, like the A shares are not actually very well represented in global indices yet. So that will actually also continue to be an ongoing phenomenon where A shares actually become more and more represented in global portfolios. So clients and investors should have more China in their portfolios. And the option here is really, the opportunity in an all cap product and a complementary small cap product, which offers a very differentiated exposure to really some of the very fast growing opportunity sets in China.
How do valuations for Chinese small caps compare to larger caps, but also in an international comparison?
Yeah, if you look at the MSCI China Small Cap Index, you'd see that it trades at about 10 times for its PE multiple. The All Cap Index trades around 15 times, around 16 times, so mid to high teens range. So the small cap universe definitely does look cheaper vis-a-vis that of the all cap universe. It actually also looks more attractively valued versus some of the US small caps, European and also Indian small caps. And the growth that the small cap space offers is still quite strong. Looking forwards, we're looking at probably around anywhere between 15 to 20% growth. I will caveat that there's a lot of representation in, say, real estate in the small cap index. And real estate in China actually is a sector that trades at very low PE multiples. So if we normalize for that exposure, you'd find that the small cap index is probably trading at a low teens PE multiple range, but still, again, much more attractively valued vis-a-vis some of the other peers.
So China equity, and especially the small cap segment, is regarded as very intransparent internationally. So how do you organize your equity research in China, and how do you gather information about Chinese smaller companies?
Sure. We have actually a very deep team at Matthews, actually really focused on just the opportunity set in China. So if you look across our investment team, which is around 40 members now, you'd find that close to half of us are actually Mandarin Chinese speakers, and we spend a lot of our time, actually a considerable amount of our time, actually looking at China. So what we do also very well at Matthews is just given the amount of emphasis and focus there is on Chinese equities, we do collaborate and work very closely. And we have that opportunity to leverage off of the rest of the team to cross-fertilize ideas and share and collaborate on that front. Now, in a more opaque market, I would say that, especially investing in Chinese small caps, the corporate governance risks are very important. So our approach has been one that's a very holistic one, and includes really understanding the company inside out, as well as its value chain. And you'd find that there's a lot of information these days coming out from the whole value chains in China being listed. So we're able to actually gauge, which parts of the value chain are most attractive, and maybe which parts we should stay away from. Now, lastly, I would say that the on-the-ground efforts that we have and the touch points that we have in, having a presence in Shanghai with some of our teammates actually working out of that office, and also Hong Kong, really just helps to, again, build just conviction around how well a company's management team or its products actually stacks up, and the competitiveness of some of these business models, and whether or not they would be sustainable over the long run.
Where do you currently find value for your portfolio in the Chinese small cap markets? Which industries are you in favor of? Which kind of stocks are you bullish currently?
I think at the moment, just given how well the equity market space has done, we actually have noticed that half of the sectors in China over the last, say, 2 years have done incredibly well, but half of the sectors have done not so well. So it's a very bipolar outcome, if you will. So in the areas that have done very well, in areas such as IT, healthcare, consumer staples, what we've noticed is that the fundamentals are very, very strong. But at the same time, the PE multiple re-rating that has occurred has also been quite aggressive. So we're actually quite cognizant of where valuations are in some of these hot parts of the market. But we continue to find opportunities in the other half of the market that haven't done quite as well. So in areas such as real estate, as I mentioned, the valuations are still actually quite attractive. Many real estate companies in China, if you will, trade at mid-single digit forward PE. If you look at some parts of financials, they have also not really quite kept up as some of the other peers in IT and healthcare. And in materials, that's also an opportunity as well, because this has been part of the market that hasn't performed as well. So I think we have seen a bit of the value rotation happen in the fourth quarter of last year. We're still while we see opportunities, I would say that we're still quite cautious about just the overall rotation itself, and we don't really think that it will be sustainable long term. But on the edges, I think what you'd see us do in our portfolios is actually expand the exposure a little bit to include some of these areas that really have been, they're still actually doing well and fundamentals are still there, but they have just been overlooked because they haven't been in just the more popular parts of the market. So it's in these areas that we see some opportunities unfolding. We continue to be overweight in, say, the IT sector, however, despite of its valuation and it being quite expensive. I think one of the beneficiaries in China post-trade war has actually been the IT sector. So China's push and efforts with regards to indigenous innovation is actually still going to continue regardless of what happens on the macroeconomic front. I think they've realized that they do actually need to move forwards with some of the technology innovation that they have incubated over the last couple of years, but will continue to accelerate in the future years. So this has been still an area that we have quite an outsized exposure in.
Maybe one last question for you, Winnie. How does the US-China trade conflict influence, especially the small cap segment?
Yeah, as I mentioned earlier, the bulk of small companies and their revenues are actually derived from the local domestic economy itself. So small companies as a whole have actually been a lot more insulated with regards to what happens on the geopolitical front. On the other hand, the IT sector, as we've just discussed, has actually been a very big beneficiary of what's ongoing on the trade war front. And I think this will continue. This will be a trend that continues. In the small cap space, we have actually been able to benefit from some of these developments that have happened in IT. We're not saying that, innovation will mean that China surpasses some of its developed market peers. I think it's still a very, very long way ahead. But we're working with investing in very, very small companies that have very small revenue streams, if you will. And they've been given this unprecedented opportunity to really ramp up and grow and scale very quickly. So from an earnings per share standpoint, you see that, the delta or the change of just the pace of growth has actually happened, and it will continue to be something that we continue to expect more parts of IT actually be able to benefit from. So this is something that we still continue to have quite a high conviction in going forwards. And there's many, many parts of IT, be it in semiconductors or software, that are really just at early, very, very early stages of development. And we do have quite high hopes for some of these companies that we see in China today.
So this was Winnie Chwang, portfolio manager at Matthews Asia. Thank you very much, Winnie, for being with us today and sharing your views.
Thanks, Thomas.